Hi, and welcome to Random Rogers Big Picture for the week of March 9th. Second take, sister-in-law phone call, and I'm the only one here. Anywho, fresh off of my appearance on CNBC, it included, on my part, a little bit of flopping and twitching, along with some good old-fashioned buffoonery. Got to see me in a suit, which I don't usually wear, although not actually in a suit. Chinos and kind of quasi-hiking shoes. Anywho, the point, if you didn't see the segment, and probably most of you did not, is now the time to buy financial stocks. And so, got to make my point. The person I was on with, it was Jackie someone, and I'm sorry I don't recall the name of her firm. Bell Rock Capital, maybe? Something like that? Anywho, she made a point that had arguments that you've probably heard before that are true in that they are positives for the company. She cited the capital infusions coming from all the sovereign wealth funds. How sick are you of that term? Yeah, how you doing? But so that was one point that she made. She also talked about 210 spreads, which of course is not how banks lend money. She felt that this would be a good time to go into big financial companies that have a high fee income. Okay. Kind of wanted to expand a little bit on this and talk about it. One way to think about what I was trying to say, and I don't know how effectively I communicated it, is that bigger picture, these things are not bigger than the market. Money coming in from overseas, that's good stuff, and those companies needed the money. So not minimizing that in the least. But it doesn't cause an effect to higher stock prices. 210s getting wider, that means nothing to me. That banks don't lend that way. I kind of interrupted her point. Banks don't lend that way. Nothing. So in seeing a lot of the same arguments that you've heard elsewhere, they don't matter. The market is what matters. And that's kind of the point I've been trying to make for a while. It's been right for an awfully long time, and we'll see how much longer it is right. My contention was when the curve normalizes, that's the time, to get more aggressive. Whether that to you means equal weight or overweight, that's for you to decide. It's not for me to tell you. But at that point, I will take more aggressive action within the sector, be willing to take more risk within the sector, but this is just not the right time to do that. And you're going to see this come on again, and I think maybe there will be people who come on who make a more compelling argument than the person that I was on with today, but it won't be right. This time is not different. We're a couple of years into the yield curve being, not right. Citicorp, I didn't think about this before, but it came up right in the segment beforehand. Citicorp is down 60% from its high. The XLF is down 35% from its high. I think I threw that nugget out in the interview. This is all very normal stuff. It will work its way out, and I imagine, aside from the yield curve normalizing, people will still stop asking. There won't be as many debates, let's put it that way, as to is now the time to buy financials, is not the time to buy financials. The best thing I could say about this is just wait. Talking a little bit about the stock market. I had a pretty crappy week, I would say. That is fairly obvious, but again is consistent with normal bear market behavior. There's a lot of people, I think mostly you see these online, not so much on TV, except for Nouriel Roubini, who really think that this is going to be far worse than normal. I haven't felt that way yet. I may turn out to be wrong about it, okay, and I'll own up to that if that's the case. But there's nothing about this. Everyone is very afraid. Everyone thinks that this time is going to be worse. So from that standpoint, it's not different. Do the ingredients behind or driving that sentiment, are they different? I just don't think that they are, and we'll see. But more importantly, if they are different, and that really is what should matter, is what happens. I've got a thesis. If I'm wrong, then what? And that's how you should manage your portfolio. You have a thesis. What if your thesis is wrong? Then what do you do? If you are facing something like that, that sort of dilemma, Okay, what is your backdoor strategy? What is your out? My out is, and I've talked about this several times, the double short fund will get larger. I'm sitting on quite a bit of cash. I can buy more. I can shave off a little bit more if I need to. I don't see that happening. I would think if we get to where we're between down 25 and down 30 from the high, I'm inclined to do something that looks like getting less defensive. We'll see. That could be a mistake. But keep in mind that you need to have something in place in case you are wrong, and we'll see. You know, when we get down 30, if that actually happens, maybe I'll chicken out and won't do anything. Who knows? But the point is, you know, to always challenge your thesis a little bit, and you know, I could easily have got a couple of names that are really stinking up the portfolio, as everybody does, and maybe those are candidates for sell. Either way, I'll try and get the video up if I can. Hopefully, as you can tell, I had a second Frappuccino today, or a Starbucks, so you can tell why I'm a little amped. Have a good weekend.